All right, so you know how everyone's always talking about dividend aristocrats? You know those companies with that crazy long streak of raising their payouts year after year?
Yeah, definitely those are some of the most sought-after stocks out there for a reason.
Exactly. And today we are diving into some really cool research that says it can predict the next dividend aristocrats.
Oh, wow.
Yeah. And I gotta be honest with you, even I was surprised by some of the companies on this list. So if you're into dividend investing at all, you're gonna want to stick around for this deep dive because we're about to give you the knowledge to potentially spot those future dividend stars.
I love it. It's like getting a sneak peek into the future of dividend investing.
It really is. So before we get into all the nitty-gritty of how to spot these future dividend aristocrats, let's just quickly level set here.
Okay, this is good.
Remind me, what exactly is it that puts a company into that, elite dividend aristocrat club in the first place?
Right, so the big thing is that they have to have increased their dividend payments every year for at least 25 years.
25 years straight, wow.
Yeah, that's a long time. And they also have to be part of the S&P 500.
Okay, right. Now, those criteria, those aren't just random, right?
No, not at all.
They're meant to indicate something.
They're kind of like a measure of a company's overall stability, their resilience, whether they're committed to, being shareholder friendly.
Yeah, it's like getting a gold star for good behavior in the world of investing, right?
Exactly. And it basically tells investors, hey, this company has been around the block, they've gone through tough times, and they've still managed to share their success with us.
Love that. But the question is, how do we spot those superstar qualities in a company before they hit that magical 25-year mark?
That's the million-dollar question.
Right. So that's where this research comes in. And they actually lay out 6 key factors to look at, which we're going to dig into. This is where it gets really interesting.
Yeah, absolutely. I'm excited to unpack these.
So we're going to look at their dividend growth history, earnings stability and growth, payout ratio, free cash flow generation. We've also got debt levels and interest coverage. And then finally, we'll take a look at industry trends and a company's economic moat.
It's like a financial health checkup for these companies.
I love that analogy. So let's start with dividend growth history. Our research recommends we look for companies with a streak of dividend increases between 15 and 24 years.
Okay, so not quite 25 yet.
Not quite, but still a pretty impressive track record. Why do you think that specific range is so important?
Well, if a company just increases its dividend for like 1 year, that could just be like a one-time thing, a fluke.
Right. Not necessarily a sign of things to come.
Exactly. But if they've been consistently raising it for like 15, 18, even 20 years.
Okay, yeah, that's different.
That's a much stronger indicator that they're serious about rewarding their investors over the long term.
I like to call that putting your money where your mouth is.
For sure.
Actions speak louder than words, right? Okay, but consistent dividend growth, that needs fuel to keep it going, doesn't it?
It absolutely does. And that's where earning stability and growth come into the picture.
Yeah, tell me more about that.
Okay, so think about like General Motors back in the 2000s. Their earnings were like a roller coaster, up and down all the time. And eventually, that caught up with them. They had to slash their dividend during the financial crisis, and it took them forever to bounce back.
Oof. Yeah, that's a rough situation.
Right. But then you look at a company like Coca-Cola, a classic dividend aristocrat. They've been remarkably steady with their earnings through all sorts of economic ups and downs. And that steady performance has let them raise their dividend like clockwork for, I don't know how many decades now.
So basically, if a company's earnings are all over the place, their dividend is going to be on shaky ground too.
Pretty much. It's like trying to build a house on a foundation of sand.
Mm.
You need that solid bedrock of steady earnings growth to support those rising dividend payments.
Okay, that makes total sense. Earnings, check. Now, I'm a little curious about this payout ratio thing.
Oh, yeah, that's a good one.
How much of their earnings should a company actually be paying out as dividends? Is there like a sweet spot?
Yeah, there definitely is. The payout ratio tells us what percentage of their earnings a company is actually giving back to shareholders as dividends. And ideally, we're looking for something, below 60%.
60%, okay. What's so special about that number?
It's all about balance. Let's say a company is paying out like 90% of its earnings as dividends.
Wow, okay.
Yeah, sounds great at first glance, right? Investors are happy. But that leaves them with hardly any money to reinvest back into the business, for developing new products, expanding operations, or even just dealing with unexpected problems.
So they're basically living paycheck to paycheck.
Exactly. One little hiccup, and their whole dividend could be at risk.
That's a great way to put it.
a lower payout ratio, like 40% or 50%, that tells me that the company's thinking long term. They're keeping enough cash on hand to grow the business, which ultimately means they can keep raising those dividends over time.
Sustainability, I like it. Payout ratio, got it. Okay, now let's tackle this free cash flow beast, or FCF as the cool kids call it.
Right. It sounds kind of intimidating, but it's actually pretty straightforward.
It does sound a little scary. But seriously, though, why is free cash flow so important when we're trying to find these potential dividend aristocrats?
Think of free cash flow as the company's financial cushion.
Okay,
It's the cash they have left over after paying all their bills and investing in the business.
got it.
And if they have a lot of free cash flow, that means they can easily cover their dividend payments without having to go into debt.
So it's like having a nice emergency fund.
Exactly. It's a safety net for the company. And it shows investors that they can weather a storm without cutting their dividend.
Love it. Okay, so free cash flow equals financial peace of mind. Awesome. All right, now we're getting into the territory that can make even seasoned investors a little nervous. Debt levels and interest coverage.
Yeah, that can be a scary word.
It can be, but how can we make this relevant to the average person listening?
Okay, so imagine you've got a mortgage and a car loan, and all of a sudden, interest rates go way up.
Not a good feeling.
Right. Your monthly payments just skyrocketed, and suddenly you have a lot less money to spend on other things.
Yeah, been there, done that. Not fun.
It's the same for companies. If they have tons of debt and their interest payments are really high, that can really limit their ability to consistently increase their dividend, especially when interest rates are on the rise.
It's like they're stuck in a financial treadmill, just trying to keep up with those interest payments.
Exactly. There's less wiggle room to reward shareholders.
So responsible debt management is key for both companies and individuals.
Absolutely. All right, so we've covered 5 factors so far. Ready for the final one?
Hit me with it.
Okay, this one's a little more big picture. Industry trends and a company's economic moat.
Interesting. What do we need to be paying attention to here?
So we want to take a step back and look at the long-term outlook for the whole industry that the company operates in. Is it growing? Is it facing major disruption?
Okay, yeah, that makes sense. You don't want to be investing in a dying industry.
Exactly. And then we got to ask, does this company have a strong competitive advantage? Something that sets them apart and protects their profits. Economists call this an economic moat.
Ah, the moat. I love that image. It's like a fortress around their business. So even if a company checks all the other boxes, but they're in a shrinking industry or facing tons of competition, they might not be a reliable dividend grower in the long run.
Exactly. You could have a company with amazing financials, but if their industry is going downhill, it's going to be hard for them to keep those dividends flowing.
It's like a beautiful ship stuck in the Arctic. It doesn't matter how well built it is if it can't move.
Exactly. Now, a classic example of an economic moat is brand loyalty. Think about Coca-Cola.
Ah, the classic Coke example.
They've built such a powerful brand over decades that people will literally pay more for their products.
Totally. I'm definitely guilty of that.
Right. That gives them a huge edge over their competitors and helps them maintain that steady profitability, which of course helps support their dividend.
Makes perfect sense. What about a company like Visa? Their moat is their massive global network, right? It would be almost impossible for someone else to come in and replicate that.
Absolutely. That's a great example of a network-based moat.
So it sounds like we need to be looking at both the company's internal strengths, like its financial health and management team, and those external factors that could affect its future.
Precisely. It's a holistic view.
Okay, wow, we just went through a lot of information.
We did. But that was just the foundation.
Right. Now it's time to put these factors to the test, because our research actually highlights 5 companies that are potentially on the verge of becoming dividend aristocrats. And I have to say, some of these names really caught me off guard.
Oh, now I'm really intrigued. I know, right? But we're going to have to say that for part 2 of this deep dive. So make sure you come back for that because you're not going to want to miss it.
I'll be here.
Welcome back. All right, so we just spent a good chunk of time really breaking down those 6 key factors that can help us spot these potential dividend aristocrats.
Yeah, those are really the building blocks.
Exactly. But now I kind of want to zoom out a bit. Look at the bigger picture. What are some of the big trends that are out there shaping the future of these dividend powerhouses? I think this is where it gets really exciting, because if you can identify those macro trends, it can give you a real edge as an investor.
Yeah, it's like having a roadmap.
Yeah.
right? If you know where things are headed, it's a lot easier to navigate.
Totally. So let's talk sectors. What's catching your eye? What are some of the areas that you think could be like a hotbed for these future dividend aristocrats?
You know, one of the most interesting shifts we're seeing is actually in the tech sector.
Oh, really? Yeah. Traditionally, tech companies, they were all about that rapid growth, pouring all their profits back into research and development and expansion.
Right, right. They were the disruptors.
Exactly.
Yeah.
But now, as a lot of these tech giants are maturing and generating tons of cash flow, they're starting to prioritize shareholder returns, through dividends.
So they're like the rebellious teenager who's finally grown up and gotten a real job.
Uh-huh. Yeah, something like
They're
that.
ready to share their wealth a little bit.
Exactly.
Mhm.
And companies like Apple, Microsoft, Broadcom, they're kind of leading the charge here, showing everyone that tech stocks can actually be a great part of a dividend growth portfolio.
Interesting. So tech is definitely on the radar. What about some of those companies that have been quietly churning out dividends for decades?
Oh, yeah, the steady eddies.
Right. They may not always be the most exciting companies, but they've got that rock-solid track record. What's the story there?
Well, sectors like healthcare and consumer staples, they're still going strong.
Makes sense. Healthcare, I mean, that's always going to be in demand, especially as the global population continues to age.
Exactly, and that creates really stable demand for healthcare services and products.
Yeah.
So companies in this sector, they've got a pretty solid tailwind.
Yeah, healthcare is essential
Yeah.
no matter what the economy is doing. And then there's those consumer staples companies. I mean, they're the ones making the stuff we use every single day, toothpaste, toilet paper,
Yeah.
the essentials.
Exactly. And these companies, they tend to operate in industries that aren't as affected by economic ups and downs. Less cyclical.
It's like that saying, come rain or shine, people still need to brush their teeth and buy groceries.
Exactly. And that stability makes them really attractive for dividend investors who are looking for that consistent income stream.
Okay, so we've got healthcare, we've got consumer staples. Those are kind of the tried and true sectors. But what about some of these newer industries that are emerging? What about things like renewable energy?
Now you're talking. The global shift towards renewable energy, that's creating some really exciting opportunities for dividend investors.
Yeah, we talked about Nexstar Energy earlier. Are there any other players in that space that you think could be potential future dividend aristocrats?
Oh, absolutely. Companies involved in solar, wind, all sorts of clean energy technologies, they're likely to see huge growth in the coming years. And as their revenues and profits grow, that means they'll have more cash flow to distribute to shareholders.
So it's not just about being good for the planet, it's about aligning your portfolio with some powerful long-term trends. But let's be real for a second. Even with all this data and insights, predicting the future, it always comes with some risks. What are some of the challenges that could potentially derail a company's journey to becoming a dividend aristocrat?
Right. No investment is completely risk-free. One of the biggest threats out there is always going to be economic recessions.
Yeah, it makes sense. When the economy takes a hit, everything feels it.
Exactly. Consumer spending can drop, businesses might start cutting back on investments, and corporate profits can suffer. And this can actually force even the most well-established companies to maybe pause or even cut their dividends to conserve cash.
So even those dividend aristocrats, those seemingly invincible companies, they're not immune to these economic downturns.
Nope, they're not invincible.
That's a good reminder that diversification is key. Don't put all your eggs in one basket, even if that basket seems really, really sturdy.
I agree.
What else should we be watching out for?
Well, regulatory changes can be a big one.
Oh, yeah, that's true. Governments can implement new policies that can have a huge impact on entire industries.
Exactly. And those changes can create a lot of uncertainty and volatility and affect a company's profitability. And that can definitely trickle down and affect their ability to keep that dividend growth going.
So keeping an eye on the political and regulatory landscape, that's important too.
It is. And then, of course, there's always competition.
Ah, yes, competition. That never goes away.
Nope. No matter how dominant a company seems today, there's always the risk of some disruptive technology or new competitor coming along. And they can quickly eat away at a company's market share and their profits, which can definitely jeopardize their ability to sustain those dividend increases.
It's like that classic story of Blockbuster Video, right? They were the kings of video rentals, but they totally missed the boat on streaming services like Netflix.
Exactly. And it just goes to show how important it is to invest in companies that aren't just strong today, but also adaptable, innovative, companies that can actually thrive in a world that's constantly changing.
So we've got economic recessions, regulatory changes, and disruptive competition. Anything else we need to be mindful of?
One more thing. Rising interest rates.
Oh, yeah. That's a big one these days. When interest rates go up, it becomes a lot more expensive for companies to borrow money.
Exactly. And that can really increase their debt burden, reduce their free cash flow, and potentially limit their ability to increase those dividends.
Right. And not only that, but rising rates can also make bonds more attractive to investors, which could pull money away from those dividend-paying stocks.
Exactly. It's all about relative attractiveness. When bonds are offering higher yields with less perceived risk, some investors might shift their money around, which can put downward pressure on dividend stock prices.
So as investors, we need to be aware of all these potential headwinds, these factors that could work against us. But even with all those risks, I'm still feeling optimistic about the future of dividend investing. I mean, there are so many exciting companies and trends to watch.
I agree. It's definitely a dynamic landscape out there. And with the right knowledge, a data-driven approach, and a little bit of patience, I really believe it's possible to build a portfolio that can generate a steady stream of passive income for years to come.
Awesome. All right, so we've analyzed some specific companies, explored those emerging trends, and we've even acknowledged the risks involved. Coming up in part 3, we're going to bring it all together and leave you with some thought-provoking questions to help you apply all these insights to your own investment journey. So stick around. All right, welcome back to the show. So we've spent this entire deep dive really getting into the world of future dividend aristocrats.
We have. It's been quite a journey.
It has. We've gone through those 6 key factors, those emerging trends, and even those potential risks that are out there. But now I think it's time to kind of bring it all home. What does this actually mean for you as an investor, for your portfolio?
Right. It's all about putting these insights into action.
Exactly. So let's just do a quick recap. First, we dove deep into those 6 crucial factors for spotting these potential dividend aristocrats.
Yeah, those were our building blocks.
Right. We talked about dividend growth history,
Yeah.
earnings stability, payout ratio,
Free cash flow.
debt levels, and then finally, industry trends and that all-important economic moat.
It's like a checklist for evaluating a company's dividend potential.
Yeah. I feel like just understanding the 6 factors, that gives us a huge leg up.
Absolutely. It's not just about looking at past performance. It's about understanding what drives those consistent dividend increases.
And then we also explored some of those broader trends that are out there shaping the whole investment landscape, things like the rise of tech and healthcare dividends,
Right.
the clean energy boom, and even the kind of enduring strength of those consumer staples and industrial companies.
Those are the classic dividend payers.
They are. I was actually thinking about this as we were talking about those trends. It made me realize that my own portfolio is probably a little too heavy in those safe traditional sectors.
Yeah, it's easy to get comfortable with what's familiar.
It is. Maybe I need to, spice things up a little bit, add some tech or some renewable energy exposure.
That's a great takeaway. Identifying these macro trends can really help you find new opportunities.
It can. But of course, we also talked about those potential roadblocks that are out there, things like economic recessions, regulatory changes,
Disruptive competition.
and rising interest rates.
Even the most promising companies can face challenges.
They can. It kind of reminds me of that quote, "The only constant is change."
So true.
Yeah.
And that's why it's so important to be adaptable as an investor.
Yeah. You have to stay informed, be ready to adjust your strategy as needed. The investment landscape is always evolving.
Exactly. It's a continuous learning process.
It really is. So I think the biggest takeaway here, the thing I'm walking away with, is that identifying these potential dividend aristocrats, it's not like a one-time thing. It's an ongoing journey.
It absolutely is.
It's about research, observation, and constantly being willing to adjust.
You got to stay curious, dig into the data, and never stop learning.
So as we wrap up this deep dive, I want to leave you with this. Which of these factors, which of these trends really resonated with you? What are some companies that you're already watching that maybe fit the bill? And what new areas are you now kind of inspired to explore? Think about it.
I think that's a great challenge. And remember, dividend investing is for everyone,
It is.
no matter where you are in your investing journey.
So keep exploring,
Yeah.
keep learning, and keep building that dividend dream team.